Iran's real estate market in 2025 to 2026 is defined by extreme volatility, structural shortages, and the long shadow of sanctions, creating a landscape where property functions less as a traditional asset class and more as a defensive shelter against economic instability. Prices in major cities, especially Tehran, have surged dramatically over the past 5 years, with values tripling between 2020 and 2025, as households and investors fled the collapsing real and persistent inflation by parking capital in land and housing, a trend that pushed demand far beyond what the construction sector could supply and resulted in longer selling periods as affordability eroded for ordinary buyers. Tehran's rental yields hover around 4 to 5%, while cities like Mashhad reach nearly 8%, reflecting regional differences in demand, migration patterns, and investment appetite. Yet even these yields struggle to keep pace with inflation, making capital appreciation, not cash flow, the primary motivation for buyers. The market's complexity deepens under the weight of international sanctions, which were tightened again in 2025 under renewed U.S. pressure, placing Iran on the FATF blacklist and effectively prohibiting investors from the U.S., EU, UK, Canada, Australia, Japan, and most Western jurisdictions from legally participating in the market. Even investors from countries with limited access must navigate compliance risks, restricted banking channels, and opaque regulatory frameworks that make due diligence exceptionally difficult. Domestic buyers, meanwhile, face a chronic housing shortage fueled by decades of underbuilding, rapid urbanization, and the government's inconsistent attempts to stimulate supply through subsidized construction programs that rarely meet targets. Developers struggle with high material costs, currency volatility, and limited access to foreign technology, pushing many toward barter-based arrangements, phased construction, and integrated project models designed to reduce financial exposure and accelerate sales cycles, a trend increasingly visible in large mixed-use and residential projects across Tehran, Mashhad, and Isfahan. Political instability adds another layer of uncertainty. Protests in late 2025 and early 2026 heightened investor anxiety, as unrest tends to ripple into global energy markets, raising inflation expectations and influencing interest rate paths worldwide, which in turn affects cap rates, financing costs, and cross-border capital flows. Although Iran's real estate market is largely insulated from foreign capital due to sanctions, global macro shifts still shape domestic sentiment and the perceived safety of real estate as a hedge against economic shocks. Looking ahead to 2026 and beyond, the market is expected to remain bifurcated. Luxury and high-end developments continue attracting capital from wealthier Iranians seeking stability, while middle and lower-income households face worsening affordability as wages fail to keep pace with housing inflation. Forecasts through 2031 suggest continued demand for residential, commercial, and mixed-use properties, with growth driven primarily by domestic investors and institutional players operating within Iran's constrained financial ecosystem, though the sector's trajectory will ultimately hinge on macroeconomic reforms, sanctions relief, and the government's ability to stabilize the currency and expand housing supply at scale.